All right, so as many of you know by now, and in fact, hopefully all of you know by now, that we are facing a pretty major inflation crisis, not only in the US, but also throughout the entire world, right? We're seeing basically in the US, for example, 40-year highs in inflation. For example, gas prices are tripling and quadrupling in certain places, and ultimately it's pretty much out of control. Now, that being said, fortunately, however, the big brains at the Federal Reserve, who of course caused this whole inflation mess to begin with, are rapidly increasing interest rates to combat the inflation, right? That's pretty much the most effective way to reduce inflation. And so over the course of the coming months and coming years, we're going to see how this response by the Federal Reserve is going to impact the inflation crisis. Hopefully, we do see prices across the board come back down to a more normal level, and that way we no longer have to spend our entire paychecks on filling up our tanks at the gas station. But for this video, we're going to focus instead on how these rising interest rates are going to impact options traders, right? Are these rising rates going to improve your positions? Are they going to be a detriment to your positions? What is the impact? And this is a very important thing to look at because, as you should also know, of course, option prices are calculated by taking into account a variety of things, such as the stock price, of course, implied volatility, the time until expiration, dividends, if any, as well as interest rates. And so specifically here, we're going to first focus on just conceptually how interest rates impact call option prices and put option prices. The impact here is different. And then after that, I'll show you the exact extent to which an increase in interest rates will impact the prices of each contract. Right? So for example, if interest rates go up by 1% or 2%, is that going to have a huge impact on your call or put option positions? Or is it going to have a very small impact? Well, in this video, you're going to find out. Now, real quick, in case you guys are interested in perhaps getting quite literally some free stock or free money, I have some very cool opportunities and promotions in the description of this video, so check them out. Right? So for example, if you want to get up to $200 of free stock from Tastyworks, or a bunch of free stocks from Webull, or free money from SoFi, etc., again, check out the relevant links in the description of this video. And then secondly here, in case you're brand new to the channel, I also want to let you know that you can find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And I also provided some links to a few of my introductory courses in the description of this video as well. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1 month free trial. Okay, so first up here, let's take a look at exactly how interest rates impact call option prices. And the best way to do this, in my opinion, is through an example where we're going to compare two different ways of getting long or basically purchasing shares of stock. So let's say there's some stock that you're bullish on right now, call it ABC, and currently it's trading for a price of $100 per share. Now, there's two different ways you can get long on the stock. The first way is to simply buy 100 shares of the stock. So in this case, if you wanted to go through with this would require $10,000 of capital, right? Because 100 shares times a price of $100 equals $10,000. And let's also say, for the sake of this example, that you borrowed this money, this full $10,000 from your broker to then purchase the stock. So therefore, as a result of that, you are going to be paying interest on that loaned amount to you of $10,000. And so that's the first way you can get long on this particular stock. The second way now is to, instead of buying the stock, you can purchase a call option with an at-the-money strike of $100. And let's say this call option is trading right now for a price of $1,200. And let's also say if you wanted to go with this route, you would also be borrowing the full $1,200 from your broker. So now, assuming you did go with this route and you bought the call option for only $1,200, then comparing this to the first possible way to get long on the stock by buying 100 shares, you're going to save $8,800, right? Because the difference of borrowing $10,000 or borrowing only $1,200 is $8,800. So therefore, as the call option buyer, you can take your savings of $8,800 and put that into an interest-bearing account, earning the risk-free interest rate. And so ultimately here, if interest rates do increase, then that's going to be a good thing for you as the call option buyer, because you're going to be accruing more and more interest on your savings of $8,800 while paying a much smaller interest payment on your borrowed funds of only $1,200. So through these examples and through this comparison, basically, hopefully you can see that rising interest rates are going to benefit call option buyers. And as a result of that, basically to reflect this benefit, call option prices will increase when interest rates also increase. And then conversely, of course, when interest rates decrease, call option prices decrease as well. So that's the impact of interest rates on call options, but now what about for put options? And so once again, we're going to take a look at two different examples, basically a comparison to see how someone can get bearish on a stock or basically hope that the price goes down. So once again here, let's say we have the same setup. You're bearish on some stock, call it ABC, and currently it's trading at $100 per share. And so of course, just like with buying stock, there are two different ways you can do this. The first way is to simply short sell shares of the actual stock. So therefore, if you wanted to short sell 100 shares of the stock, that would actually bring in $10,000 of capital. You would receive that amount, right? Because basically the way short selling works is you first borrow the stock from your broker and then you sell it immediately in the market. So of course, when you sell that stock, you're going to bring in capital. And once you have that capital in your account, you can actually accrue or earn interest on that amount. And then the second way you can get bearish on a stock is by purchasing a put option with an at-the-money strike of $100 in this case. And once again, let's assume that put option price is $1,200 and you borrowed that money from your broker to purchase that put option. So now the main difference here is for the short stock seller, they're actually earning interest. They're making money on the capital they received after shorting the stock. Whereas for the put option buyer, they're actually paying interest on the borrowed capital they used to purchase that put option. So therefore, if interest rates increase, that's going to hurt the put option buyer because now their interest payments are going to increase more and more. And ultimately, that means to reflect this disadvantage for put option buyers when interest rates do increase. That means when rates do increase, put option prices will go down. And then conversely, once again, when interest rates go down, put option prices will go up. All right, so now at this point, we've covered just conceptually how interest rates impact call option prices and put option prices. But now what about the magnitude or basically the extent to which a move in interest rates will impact their prices? Right, so are options very sensitive to a move in interest rates? And therefore, if rates do increase by perhaps 0.5% or 1%, is that going to have a huge impact on your option positions? Or does a move in rates have a very small impact? Well, now we're going to find out. And to do this, we're now going to jump over to my computer real quick, and I'm going to show you a basic simulation that I set up, which is based on the Black-Scholes option pricing model. And it's going to show you quite clearly exactly the extent to which a move in interest rates will impact your option positions. So let's get started. All right, guys, so what I'm showing you here is the output of the simulation I just ran. It's all based on some Python code I wrote up, which, like I said, applies the Black-Scholes option pricing model. And that's basically just a series of mathematical equations used to calculate the theoretical price for either a call option or a put option. And so in particular, this is a graph where on the x-axis, we're basically changing the 1-year risk-free interest rate, or basically the interest rate corresponding to 1-year US Treasuries. And as you can see, the range here is for an interest rate of either 0%, which is pretty much where rates were during COVID, and then ranging all the way up to a maximum value of 10% here, or 0.1. So just FYI here, the interest rates on the x-axis below are shown in terms of a decimal. And then on the y-axis here, this shows you the corresponding price of either a call option or a put option based on the specific value of the 1-year interest rate. And also, just for some added context here, because like I mentioned earlier, option prices are based on many things like the stock price, implied volatility, time to expiration, interest rates, of course, etc. So therefore, the full picture here with this graph, right, because the only thing we're changing here is the actual 1-year risk-free interest rate, that means every other variable is held constant. So basically in the simulation here, I'm assuming the corresponding stock price is $100 per share, just like in my earlier examples. The strike price of both the call and the put in this graph are also $100. Implied volatility is 50%, and both contracts, the call and the put, have 30 days until expiration. And so now with all that being said, let's focus first on this blue line right here, which corresponds to a call option, which you can see there in the legend on this graph. And so as you can see, when the interest rate is exactly 0%, the price of both the call option and the put option, which is in orange here, is around $5 and call it 72 cents on a per share basis, or in total, times 100 shares, that'd be about $572. And so the first important takeaway here is when interest rates are 0%, then like I just mentioned, the at-the-money call options and put options will have the exact same price, right? Because again, here in our scenario, the stock price is $100 per share, and both the call and put here have a strike price of exactly $100 at the money. But now once interest rates start to rise above 0%, then you will see the prices of call options and put options begin to diverge. And like I explained earlier, when interest rates do rise, then so will the prices of call options. And then for the put option here in orange, again, as interest rates rise, the prices of put options will fall. And so the second major takeaway here from this graph is the fact that the relationship between interest rates and either call or put prices is completely linear, meaning the rate at which the price of a put option drops or the rate at which the price of a call option increases stays constant as interest rates do rise. Right? Essentially, for example, this relationship is not exponential, where in that case, you would see these lines actually curve upwards, or in the case for the put option, curve downwards. But obviously, as you can see here, these are both just perfectly straight lines. And then finally, the third major takeaway here is that, as you can also see by this graph, the impact of a dramatic increase in interest rates, right, going from 0% all the way to 10%, has a very, very small impact on the prices of call options and put options. Right? For example, with a call option here, when interest rates are 0%, the price of the call is about $5.72. But even if rates were to go all the way up to 10%, then the theoretical price for this call option has only increased to about $6.05. So therefore, the difference here is only about 35 cents on a per share basis again. Or in total, times 100 shares, that's a difference of 35 bucks. And so, of course, that's definitely not a negligible amount of change in the price here. But again, that's in the case of interest rates going from 0% to 10%, which is definitely not going to happen even with inflation being so out of control right now. Right? So really, we're talking about interest rates going from near zero, where they were during COVID, to maybe 1% or 2%, maybe 3% on the highest end, in which case, as you can see in the zone here, prices between calls and puts will hardly change at all. I mean, basically here, if you look at interest rates going from 0% to 3%, call options and put options will move in price by about 10 cents or so at the most, almost nothing. And moreover, also keep in mind that rates do not change dramatically overnight, right? It's not like we're going to go from 0% to 3% by tomorrow. This is a very gradual, slow-moving change over the course of many months or years. So really, you will not see hardly any impact at all on your option positions. So yeah, unfortunately, definitely not a very climactic ending here. But the truth really is that even with the Federal Reserve increasing interest rates at pretty much a record-setting pace, that's really going to have practically no impact at all on call options or put options. So ultimately, option buyers and sellers should be mostly concerned with their positions being impacted by the actual stock price or by implied volatility changing or time decay, things like that. But interest rates, not really at all. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want some free stock or quite literally some free money, then check out the opportunities and promotions I have shown in the description of this video. And also, if you have an interest in taking some detailed classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links also in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.